Thank you, Steve, for hosting this event. What a treat it is as an American to be invited to a jubilee. We don't have those. And when we were working on some of the earliest deals in the sector in the mid-1990s, we had no idea that we would become old war horses celebrating a jubilee, but Alan Punter and I are delighted to take on that role. So thank you for hosting this conference to celebrate over a quarter century. Thank you to Alan for writing a wonderful guide. Alan has been working on this for quite some time, 25 years and 25 landmark deals. This anniversary celebration is important. The innovations in this market have contributed to the overall success of the catastrophe market expansion over the past 2 decades. They've also contributed to the capital markets. You may or may not all realize that some of the early structures and credit derivatives took inspiration from the nascent catastrophe market. And it's important to have this conference now and to commemorate 25 years because the cat market, the cat bond market, and the broader reinsurance market are all wrestling with and reconsidering some aspects of their structure in light of the difficult experience of the last 5 years. So it's a good time to take stock. Let me offer a brief history. While we're celebrating the first 144A securitization of cat risk on December 23rd, 1996, let's give credit to earlier instigators, innovators, and intellectuals. The instigator was definitely Hurricane Andrew, a Cat 5 Dade County landfall in 1992 that shocked the reinsurance world by producing a loss at the time of over $15 billion. Current estimates for a repeat exceed $60 billion. Andrew, together with Hugo in 1989, followed 20 years of relatively modest hurricane experience. From Camille to Hugo, there was not a really significant insured loss event from hurricanes. That's 69 to 89. And that event joined with the European windstorms of 1990, Northridge and Kobe quakes of 1994 and 5, to create an overall sense of urgency in catastrophe markets regarding capacity. In the aftermath of Hurricane Andrew, Diego Waters and others proposed the AIG Combined Risk Note, which was ultimately completed in a small placement. Engerhard Mueller and Dirk Lohmann and others at Hanover Re worked with John Kelly at Citibank to complete Cover in 1994 and secured collateralized protection from a consortium of reinsurers and capital markets investors. Richard Sander, Morton Lane, Jim Tilley at Morgan Stanley, Ken Fruit at Harvard, Howard Cronruther at Penn, and others who I'm certain I'm neglecting, proposed larger scale capital markets instruments to carry peak risks from the reinsurance sector into the capital markets. Several law firms and several investment banks did foundational work obtaining rulings or opinions from nearly every state that confirmed that securitizations of cat risk would be regulated as bonds and not insurance. There were so many conferences. The joke at the time was that there were more conferences than deals. Steve is happily helping us catch up with that same dilemma in the other direction. All this work culminated in the mad, hot summer and fall of 1996, 26 years ago now. One after another, the first true securitization for the market appeared and then fell away. Residential Re 1996 was launched and later pulled because it fell below its target minimum size. A large deal for the California Earthquake Authority was canceled when Berkshire Hathaway stepped in front of the market and took the risk in reinsurance form. A reinsurer ILW was fully placed and then pulled over indemnification issues. Finally, after months of marketing, St. Paul completed Georgetown Re on essentially the last possible day of the year to permit a Jan 1 inception. Reinsurers and brokers loomed in the background, promising a fully stocked conference room to kick off the reinsurance placement. They taunted us with that. The deal itself had last-minute wobbles around tax opinions, but it got done. I remember our team getting the call from the CEA letting us know that our deal had died and been replaced. Well, it seemed as though the sector could be headed for stillbirth And some of the bankers at Goldman working on the early deals began to wonder, should we move on to other sectors? In some ways, Berkshire's action confirmed the potential value to investors. Once Georgetown Re breached the wall, the follow-on was swift and decisive. A series of deals in 1997 hinted at the potential breadth and depth of the market. Residential Re 1997 generated an order book exceeding $1 billion, astounding to the reinsurance market in those days, and it closed triumphantly with over $400 million of risk. The possibility to place risk on that scale motivated many potential issuers to invest in starting to develop securitization programs. Swiss Re completed the first ILW securitization for the CEA, the California Earthquake Authority, for California earthquake risk, not for the CEA, excuse me. Tokyo Marine completed Parametric Re, the first securitization of Japan quake risk and one of the earliest parametric coverages of any sort in the fall of 1997. There were smaller securitizations of industrial risks and Swiss hail that suggested that a broad range of perils could be headed to the market. Little did we understand at the exuberant closing dinners of 1997 that that season of triumph was launching us down the long, thin side of a hockey stick and not toward the heavens up the blade. Cat risk in the capital markets was always, above all, in the capital markets. And as we passed year-end 1997, global debt markets left behind the frothiness of the mid-1990s and entered choppier and higher spread seas, kicked up by the Asian debt crisis, the collapse of long-term capital management, itself a notable early cat bond investor, the collapse of the internet bubble, and the difficulties of WorldCom and Enron. At the same time, and in part because of the entry of the capital markets, reinsurance capacity and appetite for cat risk grew, and pricing descended from the post-Andrew peak into the Y2K soft market. At Goldman, we divided market regimes into 4 quadrants: bull and bear markets, or frothy and choppy markets, and then hard and soft markets. By the late 1990s and into the early 2000s, we found ourselves parked in a soft bear market for about 6 or 7 years. In hindsight, this period of doldrums in the cat markets was strengthening, if not enriching for all concerned. In order to clear the capital markets, deals needed to be priced at the top of the reinsurance market. This forced dealers to work hard on issues like collateral security and term structure to create value for issuers, and also to make the process less expensive and less burdensome. On the other side, deals were sold with a modest premium to other types of risk, and dealers needed to produce deals that were sharply modeled and structured to sell the value of diversification in order to clear the capital markets. Volumes from 1997 until 2005 were range-bound at $1 to $2 billion per year. The dealer community dwindled down to a couple of dealers because of these low volumes. Many issuers completed their first deals and issued occasionally to maintain their platforms, and several cat funds got their start and built investor bases: Nephila, Fermat, the precursors to Credit Suisse, Coriolis. Some of the earliest sidecars were also completed. And then everything changed again. First, as we rolled toward the end of 2004, the capital markets entered a period of exuberance that would last into the summer of 2007. The reinsurance markets, in the wake of 7 major hurricanes in 04-05, hardened dramatically. In the aftermath of Hurricane Katrina, we were back in a hard bull market and issuance of all sorts: cat bonds, collateralized reinsurance, and the nascent sidecar market all soared. And everything worked exactly the way it was supposed to, or close. Katrina was supposed to be big enough to maybe hit one deal, but not really big enough to hit a lot of deals. And that is exactly what it did. From a reinsurance perspective, it was reassuring that the bonds produced at least some recovery. Most remaining bonds quickly traded back to par. Issuance surged and provided the reinsurance market with billions of additional capacity at a point of constraint. Within a year and a half, the capital markets started their descent into the financial crisis, and the bonds continued to work. Many of the hedge funds that stepped into the cat market after Katrina turned around and began selling their cat bonds because it was one of the best sectors to raise capital from. We called that the ATM effect. But reinsurers and other investors picked up those bonds as they traded off because the reinsurance pricing began to be attractive in the bonds. So despite selling by these hedge funds, pricing held up just below par. 4 bonds did take some losses due to aggressive collateral accounts wrapped by Lehman Brothers total return swaps, but the losses were ultimately limited. And in the balance of the sector adopted tighter collateral and disclosure rules. Finally, 2006 to 9 were reasonably clear years in the ocean, and investors enjoyed some of the highest returns in the capital markets in cat risk through that crisis. Diversification had worked. That was such an important story. That was the whole point of the sector in 1995 and 6. Richard Sander used to preach that it would provide valuable diversification that would pull pensions and endowments into the sector. And for 10 years, that mirage levitated in front of us. And at January 1st, 2009, it started to materialize. There was around $10 billion of cat risk outstanding in the capital markets on that day. By June 30th, 2017, 8.5 years later, there was nearly $100 billion outstanding of cat risk in the capital markets. That's the outstanding amount, not the total issued amount. The basic functionality of cat risk in the capital markets attracted the notice of global long-term investors, pension funds, endowments, sovereign wealth managers, and the sector increased by an order of magnitude. But while the years before Katrina were strengthening, the years before Harvey were not. Softening reinsurance markets paired with robust capital markets. The diversification dog did continue to hunt, but strong inflows in the sector met with and drove falling prices and loosening terms. In the collateralized markets, named perils increasingly gave way to included but not limited to lists. With little real consequence at that point in time, there were few events outside the Pacific quakes of 2012. While it seemed to us in that falling price era that investment returns were strong, the reality over that period was that risk premia were actually falling. The difference between expected loss and spread that was being paid was falling as spreads fell. And it was actually falling more than we even knew. During that quiet period, cat risk was actually increasing. It took us a while to see it because that's the way cat risk works. You have some quiet times and then you have a resurgence of activity. But we had 10 years of climate change during a period of falling spreads. And we also had 10 years of social inflation. Those were the years when alt litigation funds got their start, and the whole practice of pairing litigation with insurance claims collection became more pervasive. Losses resurfaced in 2017 with 3 large hurricanes, Harvey, Irma, and Maria, and continued to roar for 5 long years that included 4 major typhoons, additional large hurricanes, a reemergence of wildfires in California, and all around the world, Australia, Siberia, increasingly expensive severe convective storms and derechos, blizzards, and European floods. The looser turns up and down the insurance stack from the earlier quiet period put substantial amounts of capital at risk and drove extensive capital trapping during the COVID pandemic. Loss amplification exceeded the usual demand surge adjustments due to increasing legal awards and costs associated with homeowners insurance. Outright economic inflation added another layer in recent years. Losses would grow substantially a year or 2 after events. Initially, this resurgence of events was met with enthusiasm. It was going to be 1992 or 2005 all over again with increasing prices. But for years, the pricing increased marginally, and it's arguable that they never really caught up with the shift in risk. If we use the Guy Carpenter Index, pricing has returned to the pre-2013 plateau, perhaps to 2011 levels. But that was 11 years ago, and cat risk, social inflation, and economic inflation each arguably demand a 10% layer of price in order to compensate for their change. Pricing has to be 30% or so higher to 2011 to produce the same economic deal that we offered investors in cat risk in 2011. An accident in markets extended our period of insufficient price increases. The half-dozen post-COVID newcos injected still more capital into the sector right in front of the largest events of the whole cycle, the Uri blizzard and Hurricane Ida. 5 years of heavy cat experience followed by disappointing price improvements took its toll. Some investors fell out of the habit of coming back to the market. Capacity constraints began to appear at year-end 21 and at mid-year 22 and drove another round of losses, this time in homeowners companies. More than a dozen failed in the past year, and many more curtailed their business. The sector will revive because everyone involved in the sector needs it to grow. The reinsurance market is supplying materially less capacity to the cat sector than is needed. Many companies in the southeastern U.S. came up short this year. Citizens is operating with a couple billion less reinsurance than it sought. The scale of cat risk is moving all over the world. The burnt floods last year reset expectations of the potential cost of European flood to well over $10 billion. Billion-dollar insured loss amounts are being hit regularly across a range of perils around the world. I saw one in Brazil recently. The risk is more difficult for reinsurers than it was in the past. Equity investors are showing very little enthusiasm for large property hits. Reinsurers go in their equity analyst calls and emphasize the fact that they have many other businesses besides cat, or in fact that they are exiting cat risk altogether. But there's more cat risk than ever that needs to be covered. The world is becoming more catastrophic because people and businesses are moving to cat-exposed spaces. It's becoming more catastrophic because cat-exposed spaces that didn't used to have much insurance have more insurance. Tiger Risk today felt obliged to flash the fact that there was a major earthquake in Sichuan today. And cat risk is becoming more catastrophic. The world is becoming more catastrophic because cat risk appears to be drifting to higher levels due to climate change. It will be covered in some fashion, and the price level will respond to meet that need. In some cases, there will be more government support to take the edge off. But the 2017 to 2020 dynamic of capital expanding faster than risk is over, and we should expect to see price and terms now meet the challenge of clearing the market. There is a danger that investors lose interest. Experience has generally been poor since 2017. That's a long stretch. Investors wonder whether the models are capturing climate change. They wonder whether all risks are fully priced in. They wonder whether the sheer volume of capital that they put into the markets is driving loose and weak structures. All that said, this sector remains fundamentally useful to investors. Markets are becoming more correlated all the time. Diversification is valuable. Diversification is becoming more valuable. 30 years ago, a disruption in one market would trigger disruptions in other markets on a gradual basis. Now, disruptions in the debt or equity markets trigger other markets within days. Investors are seeking refuge from correlation. So we should study our history and think about what went right and wrong and chart a course to make this a constructive jubilee. We're not here to celebrate and coast on success over cocktails, although that would be lovely. We're here to kick off a reconsideration and to drive another quarter century of growth. So I have 10 steps in front of us to do that. Number one, more bonds. Bonds have outperformed collateralized reinsurance over the past 5 years. Bonds tend to attach at higher layers, and events over the past 5 years have been more frequency-oriented. Bonds tend to be more tightly documented. They tend to have tighter definitions and processes. Bonds will be a larger share of capital markets activity in reinsurance. Number two, named perils. Included but not limited to language has provided tighter coverage to protection buyers, but it generated an enormous amount of capital trapping, particularly around COVID. And this was a source of great unhappiness to all of our investors. Number three, model all perils. There's always data. Even if a peril can't be modeled perfectly, It can be modeled somewhat on an actuarial basis, enough for the risk to be included. Otherwise, unmodeled perils should be bucketed and limited. Number 4, model all inflation. We now have economic and social inflation layering on top of demand surge. An enormous quantity of loss probability space above 20 billion consists of loss amplification. We should be running sensitivities here as well as we do for warm and cold ocean regimes. Number 5, reconsider frequency. A more intense focus on frequency, interseasonal autocorrelation, and intraseasonal autocorrelation is needed, as well as more sensitivities, in particular sensitivities around climate change. We have spent a lot of energy trying to get severity right and have not spent enough on frequency, and the past 5 years was payback. Number 6, increase primary alignment. Homeowners is generating rapidly increasing legal costs as policyholders seek to use homeowners insurance as a maintenance cover as well as a damage cover. The industry has sought to win this battle through limitations. An alternative course is to embrace this trend and provide a higher cost product that provides more. Maybe we should provide one new roof every 15 or 20 years and price for it, instead of not pricing for it and paying for it anyway, because policyholders wait for a hurricane to replace their roof. This gets us into multi-year service contracts and maybe multi-year homeowners, but perhaps a more aligned product. The reinsurance industry does need to think more about the underlying products flowing into its stacks. Number 7, use and reward technology. The industry as a whole is in the early innings of a revolution that will draw together modeling, underwriting, monitoring, administrating, and controlling risk through tech, and that can provide policyholders with better information and interaction. We need to evaluate how InsurTech tools are being used and whether they're improving risk and whether they deserve different risk pricing. Number 8, reconnect with ultimate investors. The first decade of the market involved deep public dialogue around every deal, lengthy, excruciating discussions of every risk analysis occurred in the pre-offering stage and then again in the offering stage. The market became very fast moving in recent years, but that's not all good, because the risk that's appearing, the risk that's being modeled is not exactly the same. Frequency and climate change is part of that. Social and economic inflation are part of that. We need to reinvest in those discussions with investors. And number 9, we need to reinvest in those discussions with issuers. Placement became so turnkey that the hard lessons of the period before Katrina, in some cases, were lost. And finally, number 10, broaden the sector. The bond sector has remained 90% plus concentrated in nat cat risk, which has qualities of stationariness, objectivity, and quick resolution. While the broader sector has more difficult risk analyses, it also offers greater diversification to investors and more possibility to risk transfer to issuers. Let's reinvest in a careful pioneering spirit of the early years of the market across the broader sector. We should also study the capital markets, always the context for our work. The cat bond market grew up during a quarter century of gently falling rates and geopolitical stability. We have neither of those things today. We've clearly moved on into a period of choppier markets. Western economies are paying the price for years of post-financial crisis and COVID loose money. The reinsurance market is very hard right now, and it's lightly correlated with the broader capital markets. It should be a refuge for capital. Capital should feel that again, and that's our mission today. It's a genuine mission for the sector. Happy Jubilee. Let's make the next one in 25 years better still. And now I'd like to ask Alan Punter to join me, and he's going to talk a little bit about 25 years of insurance-linked securitization through 25 landmark deals. And Alan, I want to start out by asking you a little bit. Tell me a little bit more about this book. Alan and I actually worked together on the board of an MGA, and Alan told me about a year ago that with the 25th anniversary coming, he felt inspired to write this history for the sector. So why did you choose to write this book? Why is it the right time to write this book?
Well, first I'm going to divert from that and actually pay tribute to the two people we've already heard from this morning. Without Mike and the other founding fathers, we wouldn't be here. Most of us wouldn't have jobs. I think we should pay tribute to Mike and say the other pioneers. If there were ILS Hall of Fame, Mike would be one of the first inductees. So Mike, you've done us all a great favor. We're in your debt.
Well, that's lovely. I pointed out some of the others because victory has 1,000 fathers. Defeat, of course, is an orphan. So we're rethinking the market, but we're celebrating the victory of having it reach 25 years old.
And secondly, Steve, I don't know if Steve is in the room somewhere, Steve Evans. You know, without Artemis, you know, I wouldn't have been able to operate as an academic, so I'm being a part-time academic. No, that great source of information, that sharing of knowledge, those databases, and bringing us together as a physical community as well. So, Steve, where are you? Okay. Right, sorry. You don't normally wear a tie, I didn't recognise. No, thank you, Steve, because, again, we wouldn't be here celebrating in the way we are, so a great dedication to you. So, sorry, your question was, why this book? Well, 25 years of, from the beginning to now, a fascinating period of innovation and evolution, true blossoming of the... Remember, convergence was a buzzword for many years. Well, it's actually happened. Insurance risk is being transferred to the capital markets. It's been a fantastic achievement, particularly in the relatively slow-moving world of insurance, seen from that perspective. Maybe from the capital markets, it doesn't seem remarkable. But coming from the insurance side, it is truly astounding what's been achieved. So I just wanted to capture, while some of the old war horses, maybe both of us are still around, what happened over those 25 years, because many of you weren't there 25 years ago, and so some of the things that happened or didn't happen.
I actually have 3 children that weren't even born, and one child who came of age during the Georgetown re-offering process that I posted on Artemis.
Well, so record a bit of that history, and 25 years seemed the right period, because couldn't guarantee I'll be around here to celebrate the Silver Jubilee or even the Golden Jubilee. Sorry, the Golden Jubilee. And I was lucky enough to be around at the beginning. I was working in the alternative risk transfer space in a funny operation called Integrated Risk Resources. Back in '96, we got taken over by Aon. They looked at us and said, "You're Aon Capital Markets." So '96, I became Aon Capital Markets, and so was around from that period, and so had one foot in the commercial world and another foot in the academic world, where I was of a mindset to sort of watch what's going on and think about it and build up piles of paper. So it seemed the right time, now or never. I floated the idea a little earlier, Mike, remember maybe I sort of, one of the first times I spoke to you was probably at Artemis 2017. And I said, well, 20 years of ILS in 20 deals, well, never came to anything. But 25 years, if I missed this one, I'd missed it. And this conference actually gave me, finally, a hard deadline to actually sit down finally and write it. So now you have it.
Excellent. Perfect. What was the main fact? Now, you had to go through and pick 25 deals. Yeah. And you proposed a list, and I made all sorts of suggestions, and then you held to your list. So what motivated selecting the deals? What makes a landmark deal?
Well, Steve threw in a few suggestions as well at one stage. I don't know if you remember. I don't know if you checked back how many of your suggestions I picked. Not all of them. I must emphasise it's a very, very, very personal selection. I mean, and I think all of you sat down and wrote even top 5, top 10. You wouldn't necessarily find them all in my 25. So there's not basis risk, there's bias risk in this selection. Other people have come with other ideas. As that those that answered that mini poll have showed there are other candidates that with hindsight, I might have chosen. This isn't the only 25, but it's the 25 I chose. My main criteria was innovation, deals that did something new. And so that's what I was mainly looking for.
It's actually so interesting you say that. I just talked about that. So many of the 25 deals were in that first 10 years
Yep.
when we were struggling to get traction. And in some ways, the market has become easier, but we need to return a little bit to that spirit of innovation. But talk a little bit about some of those innovations.
Yeah, because it's, for me, it's easier to identify the first deal of a type, a new peril, a new type of issue, or a new structure. It's easier to identify the first among the public ones. I mean, there's over 1,000 public ILS transactions, so I had a lot to choose from. It's easier to identify the first one, but also it's often easier from someone on the fringe to understand the early deals. Sometimes deals just get more complicated, more bells and whistles, sometimes almost for the sake of it. The early deals are usually got the bare bones. They've got the key rationale, and you can see it more clearly. So choosing the first deal was a good way to go about it. So the first deal in the book is Georgetown Re, which you mentioned.
Well, actually, your first
I
deal...
don't know how long,
Oh, gosh.
how often, when did you last see that?
Yeah. It's amazing it's not yellowed.
So that is the, what's it formerly called? The offering document for Georgetown Re 25 plus, what's it dated?
And for those that want to date the start of the market...
1966.
No.
The date of this offering is December
I was 1 year old,
1996.
1996. Right.
Very precocious, this guy.
No, the issue is when you date the start of the market, Cover is actually an excellent point, and that's 1994, and that was a Hanover deal. And combined risks is arguably a point, and even the Chicago options are arguably a point. But this artifact, this physical artifact, is the argument for using Georgetown as a starting point. It's the first time an offering circular appeared. So this is a true securitization. It could be brought to market, and it's the first deal that could actually be traded. So that's the first true securitization.
So as an academic, I squirrel this sort of stuff away, and I used to tell my students, you don't get this on the internet. You need to have hard copies sometimes.
Yeah.
Perhaps I shouldn't have it. It says confidential. Sorry. We can pass over that, shall we?
You can't buy it.
I was around at the time, so I squirreled it away. As you mentioned in your earlier speech, there were earlier attempts, some successful, some not. But yeah, Georgetown Re, I really think is a starting point. But probably even before that, the groundbreaking thing was the earthquake risk bonds, the California Earthquake Authority. And I don't know if you remember this.
Yeah, I remember that.
So the proposal for earthquake risk bonds for the California Earthquake Authority that was NTU not taken up because of Berkshire's impolite intervention. They got paid an awful lot of money.
They got paid a lot of money, but they did motivate investors to think about what they might have missed.
So, sort of moving into the more mainstream, well, not mainstream, but the first big, not the very first, but the first sort of big single peril, single year hurricane bond residential re. 1997, 96 was unsuccessful. 1997. Remember that?
Yeah, I do.
You read it? Every page?
I wrote parts of it.
So that's obviously a bond to choose because it's the first big one, very successful. You say oversubscribed 2.5 times or so, and also residential re have become the issuer. Sorry, USAA have become the issuer. Is it now 39 bonds or thereabouts? They've issued, USAA have issued one or more bond every year since. Now multi-year, multi-peril, not all cat bonds, some are quite low down the risk tower. But no, they have been the star issuer of cat bonds. They must have issued more cat bonds than any other issuer apart from Swiss Re or something like that not weighs their own risks. So as one of the respondents to the poll, I mean, quite a few people chose residential re. One of the reasons given by a poll responder, most active and historical franchise in the cat bond space. It paved the way for all other US primary issuers to issue cat bonds into the market. So that's an absolute banker, residential re, and the following ones. But some of the other, we moved away, but there were many other property bonds and cat. So then drifting away from property, drifting away necessarily from cat. Another one, which is more of a proof of concept, was the AXA Spark Next Gen Re, the 2005, 2007, when they securitized two large portfolios of personal motor risk. It excluded fleets, it excluded most catastrophe perils. Probably a proof of concept that anticipating Solvency II, could large volumes of insurance premium be securitized in the same way that credit card receivables and all the other things are being securitized to reduce the capital loading that might be imposed by Solvency II? It took a long time to do. It was done. One or two others have followed it, but
well, let me say two things about that. That's an obscure deal. A lot of people don't even know that it occurred. I remember seeing it and being really surprised and interested. That deal was the template for the development of the healthcare bond. So all the Vitality bonds work very similarly to that original Spark bond. But also, you know, in thinking about broadening the sector, the U.S. auto sector and the UK auto sector are more or less in crisis right now. The P&C industry as a whole lost money on auto in both jurisdictions. And there may be an opening to do more in auto, and that could be a really fruitful area for expansion.
Another one of the sort of first in a risk class, I picked the mortgage insurance bonds. First one, Bermuda Re, 2015, United Guarantee. There have been at least half a dozen other insurance companies that have now issued mortgage bonds, about 50 in total between them. And then finally, we moved on to the life and health sector, that the risks that have been securitized there, the excess mortality, the Vita Capital series by Swiss Re, 2003 onwards, about 8 different bonds over those years, and medical benefits, Vitality Re, 2010, and subsequent by Aetna Life. I think they've now issued 13 bonds. So many of these companies have become serial issuers, which is, I think, key to the market, isn't it? It's not just a let's try it, suck and see, that they obviously have been viewed as successful by both the issuers and investors, and they've been repeat bonds. I think the other second major key factor was evolution of trigger mechanisms, moving away from indemnity. Obviously, reinsurance insurance and reinsurance are very focused on indemnity structures. It's great that indemnity has been placed into the capital markets. It increases the capacity for transfer of risk, but it is sort of, in a way, substitution rather than natural growth. I think it's some of the non-indemnity covers that have led to real growth, getting risks that are perhaps not so insurable into a new market. So we had industry loss triggers. I picked the Swiss Re Earthquake Fund. I think the one you mentioned, 1997, is one of the early ones. But there's now, working from the Artemis deal directly, there's 184 cat bonds when I last counted with industry loss trigger indices. 36.5 billion of risk capital issued. Other non-strict indemnity was the model loss triggers. The one in the book is Gold Eagle Capital by American Re, 1999. As you say, mostly the first 10 years, because they tend to be the first deals to cover particular perils. That's the first of about 37 cat bonds using model loss triggers, another 4.25 billion of risk capital. But save up the best for last. My favourite triggers are parametric, moving away from pure indemnity. And I think you mentioned it, the first parametric deal, parametric Re, appropriately, Tokyo Marine.
Well, I don't think it's just appropriately. I think it's eponymous. I don't know of any parametric deals before parametric Re, because I remember when we were thinking of the name, like, what are we going to name this deal? And it seemed like a really good name for a deal. And now we talk about it's like Kleenex. You know, we talk about parametric risk, small p, but parametric re was the big P. And it was so interesting to develop the whole concept of, at the time, Quake in a box.
Yeah, so now, again, in that direction, something like 95 parametric deals, 14.5 billion of risk capital. So they've waxed and waned, haven't they, parametric deals? But
Well, talk a little bit about your favorite.
It's going to be parametric. I think I've given the game away. Concentric re, Oriental Land. Just the simplicity. No, it's a dartboard with the inner, middle and outer ring, earthquake size in the dartboard. It's got the score, look up the table, make the payment. A couple of days of the earthquake size and epicenter being certified, make the payment. But it's the simplicity of the structure, but even more, it's the to me, so putting my academic hat on, I've always been interested in the motivation. Why have these people done something alternative? Why did they not use the traditional insurance or reinsurance? What made the issuer look alternative? What made the investors attracted to it? So Oriental Land, the Concentric Re, Oriental Land are the operator of the Tokyo Disney Park, and that's the centre is in the picture. You told me, wasn't it? The Cinderella Fountain is at the centre of this dartboard, the centre point of this. So an earthquake anywhere near the theme park, they get a payout. Doesn't have to be any physical damage. So it was a non-damage BI, which I think, corporations makes a lot of sense to corporate buyers, because Oriental Land had debt to service they incurred in building the park. So they didn't want anything that disrupt gate receipts to harm. So the economic motivation for Oriental Land to enter this deal and the simplicity of the structure, to me, it's beautiful.
I actually have 3 small funny stories associated with that. First of all, if you look at the book at page 22, there's a picture of the Cinderella Fountain within Tokyo Disneyland. And if you go back to the underlying deal documents for the Circle and Concentric Re, which were the Oriental Land cat bonds, the center of the circle that defined the parametric region within which the hypocenter of an earthquake had to occur is actually the Cinderella Fountain itself. So that was where the lat longitude pin was dropped. This was a business interruption cover. One of the stories, it's true that they believed this, I'm not sure it was right. When we talked with Oriental Land, they actually weren't as worried about damage to the park.
No.
They believed, this is not intuitive, but their belief is that amusement parks are built to withstand, continuous magnitude 2 or 3 earthquakes because everything is shaking all the time. Now, there'd still be a lot of damage. I was like, that's great, guys, but you're still going to have a lot of cleanup. But they believed that the park was built to shake. And part of their evidence was in the Kobe earthquake, there was an amusement park on the docks in Kobe that was relatively lightly damaged. So they weren't worried about damage. They were worried about how long it would take for people to get back on the train and come out to Tokyo Disneyland. And so we didn't know how to determine that. So what we did is we studied records of the 1923 Tokyo earthquake. And our only analogy was, how long did it take for the geisha houses to get active again? And we actually did find some records that suggested it was in 18 months. So that was part of how we set that. And then another funny piece of it was Tokyo Disneyland is located on some landfill. It's a terrible place relative to quake in Tokyo Harbor. And so we had to name the deals. And the deals, one deal is Concentric and one deal is Circle Maihama. And they insisted it be named Maihama, which is their location, because it sounds like Miami. But I thought it was a terrible name because Maihama in Japanese means dancing beach. And I did not think Dancing Beach was a good name for an earthquake bond. But we reasoned that investors wouldn't get too upset about the Japanese translation. And then finally, this deal was just a barrel of laughs. The crowning glory of this deal was we had a large deal team, and a young woman on the deal team was not married yet. She later got married, but the team there noted that and then brought her a special gift from Tokyo Disneyland that if you're not married, you can get at Tokyo Disneyland, which is there's a Mickey and Minnie that are positioned in front of a small screen. And they said, if you position them facing each other, you will find marriage. And I didn't know what to do. I didn't know if I had to, I didn't know if I had to call like employee relations when I got back to the office. But she did get married. So it worked.
It worked.
It worked. So the bond worked in every way. It was a barrel of laughs.
And I think the close-up, if I'm allowed a second favourite deal, is the Swiss Re contingent capital deal. I think it's 2013. Again, parametric, just a very, very, very simple trigger. Should the SST, the Swiss solvency test for Swiss Re, fall below 125%, they have the option to get $750 million of additional capital. So simple trigger, SST ratio, access to new capital, contingent capital. Again, I'm, from an academic view, great believer in contingent capital. Have the option for capital when you need it, rather than buy it permanently and have to service it. And that optional feature, contingent feature, there haven't been too many contingent capital deals, but no, they seem beautiful to me.
Well, I think one of the problems with contingent capital deals is over time investors have caught on to the fact that issuers of contingent capital tend to have self-knowledge. You know, you would think that statistically, you know, credit defaults tend to run like 2% of all double Bs over time, you know, and less than 1% of all triple Bs. But it turns out that the conversion rate of contingent capital bonds is like 70%. So if you issue a contingent capital bond, you're likely to use it. And that's been something that investors have thought about.
But it's just that philosophy, so maybe getting too academic, but that philosophy of addressing the impact, suddenly it hits the solvency ratio, and it doesn't have to be underwriting or investment or bad management or whatever, or a combination, addressing the impact, whereas insurance always comes from the causes. And you might suffer the impact, but it's not actually one of the causes in the insurance policy. So I've always sort of focused on the corporate buyer, which I know is the minority of these deals. All the corporate deals that I could find are listed in the appendix in the book. More of a focus of impact and helping the client with the impact rather than making a list of causes, because you might miss the cause that actually hurts them.
One more question, Alan. What is we're at a real turning point in the market. You know, an exuberant birth, 10 years of struggle, 10 years of glory, 5 years of difficulty. But now entering into a very pregnant period. What does the market need to do? Where should it focus its energies right now?
Well, I'd like to see more corporates issuing cat bonds and give them access to the technology. Because again, I think that particularly with parametric-like structures, we can provide, the investor base can provide cover that they can't get through the traditional insurance market.
Well, actually, one story on that score. We did a deal that was a parametric deal. It was an earthquake deal. And it was based on spectral intensity, which is a certain way to measure earthquake ground shaking. And it was for Universal Vivendi, which had 50 or so buildings in and around Burbank, California. And Wayne Kramer was the risk manager. And I'd worked with him previously. And Wayne was actually asked by investors why he was doing a deal like that. Why, as a corporate risk manager, would he undertake basis risk when he could buy perfectly good indemnity risk in the insurance markets? And the value of that deal to him was you can measure spectral intensity and get the final measurements from the USGS within, a few weeks and either get paid or not be paid and move on.
Yeah, and that's finally pick up on that point about basis risk or parametric deals having basis risk. I'm a believer that corporates might well go, if you go to them and say, yes, you've had an event, you've got an indemnity cover, let's spend 5 years arguing about it, and then we'll pay you 80 cents on the dollar. Yeah. If you went to them and said, look, here's 75% of your policy cash, get on with life, they'd be very happy.
Well, that's what Wayne said. Wayne said to the audience, he said, and we were doing this deal, I think it was about 2003. And Northridge had been in 1994. And Wayne said, you know what? I just collected my last Northridge claim last week. So 9 years to collect my claims on an event. That's basis risk. This is trivial in comparison. So actually, that's inspirational.
Yeah, and then the following that through, the World Bank deals. If you want to help disaster recovery, you want cash within days or weeks, and you want cover for things like infrastructure that you don't insure. You just want cash to get on with disaster relief. You don't want to spend time arguing and examining policies.
Although even there, we see the limits of parametric, because I think that in the end, a tourist on a cell phone gave some data that fed into the ultimate reading, or that was at least part of the controversy around one of the Mexican wind bonds that was ultimately hit. So parametric bonds have their own struggles. You've got to make sure that the measurement mechanisms are quite sound.
I forget which deal it is that where in the event a lot of the monitoring stations were destroyed, so you didn't have the readings.
That's exactly it.
Right.
I'll wrap up with one. Alan, you may have a funny story about the market. I've got one more funny story about the market, because Jubilees should also be exuberant.
Well, the only funny story that comes to mind is when I left my boss's laptop in a New York taxi cab.
Oh my God.
But it goes on for
I think
too
I
long.
paid for that under a cyber risk contract that we had, but go on.
No, it went on. It's a very long shaggy dog story, and it had a happy resolution, but unfortunately it would take too long to tell, and it has nothing to do with ILS. So back to you.
Well, my last one, it highlights some of the tensions of the early days of the market. We had an issuer doing, I'm going to not give names to protect all the innocent. We had an issuer doing a bond that was a multi-peril coverage, and we had a few large investors, including a large asset manager, that were taking the bulk of the deal. And we were in the final stages of getting this deal done. And there was a giant tsunami in New Guinea. And I remember CNN was showing, like they were showing the New Guinea coastline, they were showing like satellite views, and before the giant tsunami occurred, there was like jungle with ocean at the edge, and then the tsunami occurred, and then there was jungle with ocean at the edge. There was like no insured property there at all, and it turns out that there are tsunamis in New Guinea from time to time. But the asset manager that was the lead investor in this deal works on a trading floor, and that CNN feed had just been on the trading floor television screen once an hour for like 3 days before the deal was supposed to close. So he came back and said, I'm still good for the deal, but you need to exclude tsunami. And this was mainly a CalQuake deal. And I said, fine, it just doesn't matter very much. And because it was defined as quakes that occurred in California. And if you think about that, if a quake occurs in California, the likelihood of there being a tsunami that hits California, it's not exactly the same thing. Usually the tsunami starts because there's an earthquake somewhere else that isn't covered. And then the waves come and they hit California. Like if you have an earthquake in the Central Valley of California, it's not going to cause a tsunami that's going to hit California. Like you can come up with some exotic cases that have to do with Mendocino County, but it's stretching.
The final comment is one criteria I didn't use that came up in several of the poll answers was bonds that had losses, because I'd focused on issuance. I didn't think about losses. So several people volunteered Camp Re because they won the first big.
Well, as I said, thank God it had a loss.
Yeah, but the final comment is Mariah Re. Someone volunteered Mariah Re, and this is their words, not mine. Because PCS, AIR, Aon and American families screwed the cat bond investors marketplace and got away with it.
Oh my God. Well, I haven't finished my story. I haven't even gotten to the. So we had this investor that was all outraged over the tsunami risk, and so I went back to the issuer, and you know, this is the early days of the market, and issuers, every request that came from investors, the issuers would get enraged about because it showed the investors didn't understand the market. And so we had this investor that came back, and I said, they want this exclusion. I don't think it really changes your coverage very much. We should just do it and close the deal. And there was this long debate about it. At one point, one of the senior managers of this company got up and said, it's clear these investors don't understand this market. This investor does not understand the important role that tsunamis play in suppressing fire following earthquake. I was like, oh my God, like, can you even imagine that? Like, you're in a city that has just experienced an earthquake, fire is raging around you, and you thank God that the tsunami has now come to put out, and that's never happened. That's never ever happened that I can think of, like, in recorded history.
Steve,
It was amazing. So that's our celebration of 25 years.
Thank you, gentlemen. I'm afraid we're not going to have time for Q&A, so yeah.